All right, so this is our first chapter in Accounting 1. It is called Accounting in Business. And we're going to be looking at the purpose of accounting, and we're going to talk about some of the basic terminology in Chapter 1. So just to kind of get us started, we're going to start with why is accounting important? So I want to kind of get you thinking and have you think about what would you describe accounting to be? So when you think of it, what do you think of for accounting? I know when I think of it as a profession that provides some kind of a service to deal with the finances of a company. So the goal for accounting is to provide reliable and relevant information so that people can make decisions. So when we look at why is it important and who uses it? Well, it's going to be important because we want to make sure that the information that's presented about a company's financials is accurate. We want to make sure that we can communicate that to whether the people are inside or outside the company. So they give some examples here of the process that we're going to be looking at, and this is going to get us started into how we analyze for accounting. So for our first one, it says that we're going to be identifying. And that's where we have to decide, some transactions may be financial transactions, but not all of them are. So we have to make sure that we know the differences. Once we identify if a transaction is financial, then we have to record it. We're going to input that information into a system in chronological order, and then that's going to allow us to keep track throughout a period of time and then run reports like financial statements. And that's going to allow those decision makers to really have an idea of what the business is doing and how they're presenting their information. All right, so the next part looks at, who is using this accounting information. And we're going to look at two sides of it. So we have the external users and the internal users. But when we're thinking about this, we have to kind of look at, why they're considered different and what kind of information are they looking at. So when we look at accounting, the goal is that our people are going to be using accounting are going to be individuals. There might be businesses using it. There might be creditors. There might be taxing authorities. And they give other examples here in this slide too. But when we think about individuals, so it's anyone who's paying the bills and handling a checking account. Businesses are using it to set goals and make decisions. Investors use it to analyze the risk and make decisions. Creditors use it to see if a person or business can repay the money that they borrowed, and taxing authorities use it to determine the amount of tax that's owed. So when we look at the two different broad categories that we see listed here, external and internal users, the external users are going to be the people that are not running that day-to-day business. So they are making decisions based on what the people that are internally are creating for each department. So when looking at the external users, they are going to be people that are, again, they're not directly involved in running the organization. So the financial accounting is the area that serves those external users. They're going to include our shareholders or investors. They're going to include lenders, external auditors, the board of directors, customers, non-managerial and non-executive employees, our suppliers, our regulators, lawyers, and they're going to have limited access to the organization's day-to-day information, but their decisions depend on information that is relevant, reliable, and comparable. Where when we're looking at our internal users, they are going to be those that are directly involved in managing the business, and people such as the chief executive officer and any department manager. They're going to use that information to help improve the efficiency and effectiveness of an organization, and they're considered to be in the managerial accounting side of it. They're serving their decision-making needs. All right, when we look at the different opportunities that are available in accounting, accounting is a very wide career area. We have anywhere from, inside a single-owned company, and you can be in a giant corporation. You can be in a privately held corporation. You can be in a public corporation. You can be in private accounting, public accounting, and here it just gives you some examples. But the point I want to maybe stress is that when we think about the opportunities that are available in accounting, they are vast. Accounting covers so many different areas, and the one thing to remember is that with any company, whether you are an accounting major or whether you are a business management major, whether you're entrepreneurship, whether you're in marketing or whatever you may be majoring in, any business has an accounting department. You have to have finances to operate a business. So you have to have accounting transactions that are recorded and presented. So any company, no matter what it is going to have accounting. So even if you're not an accounting major, having that knowledge of how things are going to work can be really critical. So I know a lot of you guys are not accounting majors, and it's important to make sure that you do know that you are able to apply what you learn in here into your field, even if you're not directly in accounting. All right, so let's look at the next part, and this goes into the ethical areas of accounting and why that's important. So one of the things I want to talk about is when we talk about accounting, our goal is to provide information that is useful for those who are making decisions. For it to be useful to someone, we have to know that the information is accurate and that we can rely on it or we can trust that information. So for us, that means that we have to have strong ethical boundaries in place to make sure that we've established that people are doing things the right way. We don't want someone to take advantage of how a company is set up and things like that. So we want to make sure that we've put strong ethical guidelines in place, and a lot of companies we are going to see actually put ethical policies in place to guide their employees of how to make those ethical decisions when they're faced with them. One of the things that we hear a lot about in accounting is fraud or misconduct, things like that. So we're going to get into kind of talking about some of those. And the first thing we're going to look at is called the fraud triangle. And this is a model that was created that basically says there are 3 factors that must exist for a person to commit fraud. The first one is opportunity, then pressure, and rationalization. So the opportunity means that a person might be able to commit fraud with a low risk of getting caught or a low perceived risk of getting caught. So what that means is there's some kind of internal control in your company that is weak that allows them to have the opportunity that they could do something and get away with it. The next part is going to be that financial pressure or the incentive. So that part says that there's some kind of pressure that's going on that they may be likely to try to commit this fraud or to do something wrong in the company. So it could be something as simple as they're not able to make ends meet at home, so they're trying to find extra money, and they found a loophole that gives them that opportunity in the company. It could be they have someone sick at home that they're trying to take care of. They could have gambling addictions. They could have drug addictions. You never know what it could be, but there could be some kind of a financial pressure that's built up from outside of work. And then the other one is rationalization, or basically like an attitude. So a person justifies that fraud, or they don't even see it as a criminal intent. And an example that I've typically used in courses is you have an employee that feels that you're not paying them adequately. So they use that as a rationalization, because they're not able to pay their bills and they found an opportunity in your company. They rationalize it. Well, they don't take care of me the way that they should. So they think it's okay to create that fraud situation. So all 3 factors in the fraud must usually exist for fraud to occur. Typically, if you've eliminated one of those 3, then your risk of fraud is lower. So the key for a company to stopping fraud is to focus on that prevention. It's much less expensive and more effective to prevent it from happening than it is to try to detect it, prove it, and address it. By the time we actually find it, that money's gone. And that investigation can cost millions of dollars depending on how large your company is. All right, so the next part that goes along with ethics is because of so many of the fraud issues or mismanagement jumbled up funds and companies. The Congress passed a law called the Sarbanes-Oxley Act. It's abbreviated by calling it SOX, where it created fines and penalties and also jail time for people that violate controls. So the idea behind Sarbanes-Oxley is that we want to have strong internal controls that are effective to manage our finances, to make sure that people are following policies and they're doing what they're supposed to do. It will allow a way to test that the internal controls are strong. And what we would do is we would have external auditors come in once a year for publicly traded companies, and they would test those internal controls that the company has set up. If a company violates it, those who are in charge, such as the CEOs or CFOs who sign off on the accounting reports, they can be held criminally responsible, and they can be fined, they can be prosecuted, they can face fines or years in prison. So that was put into place to protect those publicly traded companies and their investors and their creditors. The next one is the DoddFrank Wall Street Reform and also the Consumer Protection Act. So those are two others that were passed by Congress, and there's two important provisions with them. So the first one is the clawback provision, which mandates the recovery of excessive pay. And the other one is the whistleblower, which provides through the SEC will pay a whistleblower anywhere from 10 to 30% of the sanctions that they issue that are exceeding $1 million. So if you have, if you're the whistleblower and you're reporting it, then it allows you to be able to get rewarded for taking that risk. Okay, so the next part is going to kind of go into some of the rules that we have for accounting, and that's what I want to kind of talk about. With accounting, we talked about it being reliable, relevant, and comparable. Well, for it to be comparable, that means that we all have to be looking at the same thing. So one of the things that we're going to talk about with some of the rules that are coming up is, when you're looking at one company versus another, so we'll just make it simple. If we're looking at McDonald's and Arby's, how do we know that, if we're looking at their financials, that they're the same? Well, the reason is because we follow rules in accounting that tell each company how they should record transactions and the rules that are associated with each kind of transaction. So that if everyone follows the same rules, then we can see how to compare one statement to another, and we know that they've been prepared in the same way. So we are going to stop this video, and in our next part 2, we will continue by looking at some of the principles and assumptions and the rules that govern accounting and help to define why we do the procedures that we're going to learn in the next few chapters. So I'll see you in the next part of Chapter 1 presentations.